Hi, my name is Brent Laird. I'm a tax partner here at Kernutt Stokes. Today we're just going to talk a little about deductions. It's a common question that comes up. As they bumped the standard deduction up a few years ago, a lot of people ask, hey, do I even need to itemize anymore? Do I need to keep track of my receipts? What do I need to do? And so hopefully today we'll answer a few of those questions for you guys. There's kind of four main components that go into itemized deductions. The first is medical expenses that are unreimbursed. The second is state and local taxes and property taxes. The third's home mortgage interest, and the fourth is charitable contributions. The standard deduction is a lot higher than it used to be. It used to be right around $12,000, $13,000. Now it's about $25,000 for married filing jointly. One of the things about medical expenses that many people don't know is that in order to qualify, you have to have a certain amount above a limitation. And so there's this adjusted gross income limitation. So if you have 100 grand of income, they give you a haircut based on that income that you have. So let's say you had 7.5% was the AGI limitation for the year. That means you have to have more than $7,500 in medical expenses before you can even deduct anything. Second piece is, what do you pay in taxes for state and local and for your property taxes? You add those together and you see what your number is. And then that number is limited to $10,000. The next one that you're looking at is your home interest. What's your mortgage on your house? That has to be a qualified residence. It can't be for other purposes. And you get to deduct the interest on the first $750,000 of debt. You take your interest on that, and that's effectively what your next component of that calculation is. Really, the last one that most people are familiar with is charitable contributions, or often called donations. If it's over $250, you have to keep the receipt on it. Giving cash away isn't always the most effective strategy. One thing that you can do is give away appreciated stock. Another thing you can do is, since the standard deduction is so high anymore, you might only get a little bit more benefit by making a contribution one year. And so it might make more sense to stack contributions in the same year. So rather than give it on like December 31st of a year, maybe do it January 1st the next year, so that you kind of put them in 2 different years. They have bumped up the limitation amount for meals when you go to a restaurant. So business meals, where you go meet with the client, or you're taking your staff out to a meal out at a restaurant, are 100% deductible because they're trying to stimulate the restaurant community. With all that being said, the reality is that tax law is pretty complicated. So we're here to help you guys out. Ultimately, our goal is to make our clients' lives better, and that's what we try to do here.